Economic indicators are the key to understanding the behavior of financial markets. That is why every day in the newspapers you read what the latest economic data release is foretelling about the state of the economy. Typically, these stories are linked to something else, such as what they mean for wages, unless they are the wage data, or jobs, unless they're the jobs data, or investment, unless they are the investment data. And that is the point. Economic data released about the wider economy are endlessly being analysed for clues about what may happen next and what it means for the price and value of assets and investments that are the results of this economic activity. Therefore, the economy's ability to generate net value added, or growth, from producing goods and services forms the lifeblood of financial market activity. From bond investors to equity investors to commodity traders to private equity and hedge fund activities, their success is ultimately determined by how well the economy performs. Essentially, the tune they dance to is set by the economic outcome of the activities in which they're making their investments and looking for their returns. These financial markets play, of course, a crucial role. They make the real economy more efficient and successful by channeling investments to where it's required, by, for example, breaking up companies and disinvesting in inefficient firms, by supporting successful firms, by providing finance that is necessary to make them prosper and so help the wider economy. Of course, there can be too much of a good thing, and too much financial market activity, especially unconnected to the real economy, can and does lead to boom and bust. But that too is necessary to ensure that healthy activity is sustained and unhealthy and bad practices are not. The economic data looked at by investors range from output to price inflation, to wage inflation, to labour markets, to surveys, to fiscal trends, in short, all of it. Ultimately, growth of company profits at the aggregate level cannot be greater than the rate of growth of the economy in nominal terms as a whole. Of course, some companies can and do perform better than others at different times of their business cycle and of their evolution. It is, therefore, a dynamic process. But of more importance than simply looking at company balance sheets is looking at what is happening to the economy for a guide to how the company will perform in future. Breaking down GDP into output, income and expenditure, and why it matters for financial markets. The total net value added produced by an economy over time can be measured in terms of the gross domestic product, which has three main ways of being added up. One is in terms of the output, the second, the expenditures, and the third is all of the incomes. In this circularity, they should all be equal, but of course measurement errors creep in and an adjustment has to be made to make them sum. Data is released for all of these measures of the economy, and each are weighted according to what they mean for financial returns. As the chart shows, GDP and corporate profits are linked. Faster growth in GDP provides the cash to drive company profits and dividends. It whets investor appetite and drives up asset prices. The opposite is also true. Slower growth means slower growth in profits, and therefore equity prices could fall. Growth and inflation are also linked. The faster the rate of growth of GDP, the higher the rate of increases in inflation and in wage inflation ultimately, as the latter two are linked, each ratcheting the other up. inflation, interest rates, and fixed income returns. Inflation is linked to bond markets. As inflation erodes the real return from fixed income securities, it affects the price of bonds. Fast rising inflation means higher short-term interest rates to counter inflation. This may lead to steeper yield curves, slowing the economy down. Of course, this is not always the case. Savings behavior of households matter. Labour market data matters. What they mean for financial markets can be discerned but requires careful analysis. How monetary policy impacts the economy. Changes in official interest rates can change the rate of growth of the economy. Higher interest rates slow down the economy because they raise the cost of borrowing to investors. They also raise the cost of borrowing to households and businesses, making it more expensive for them to fund their activities. Lower interest rates speed up the rate of growth of the economy because they make it easier for firms and households to borrow and spend. Fiscal policy matters because too much government debt means that they borrow money and pay interest on it from funds that could be used by the private sector for more profitable investment. This crowds out higher productivity activity by the private part of the economy. Also, high debt levels drive up long-term interest rates and so could slow down economic growth, imposing costs on the wider economy. High debt levels also implies higher future taxes. Bond markets may not like this and could ask for higher returns as a result. In the past, high debt may have led to higher price inflation as well. Ultimately, a government cannot live beyond the ability of taxpayers to meet its debts, albeit those in the future. We know that too high level of government tax is a disincentive to economic activity, so it should be discouraged. Markets reward prudent government borrowers with low long-term interest rates and punish impudent ones with higher long-term interest rates. Debt for long-term investment is okay for governments to borrow, but not for consumption. Debt removes flexibility to respond to future crises.